Welcome to this second video on the CARO 2020 versus CARO 2016. We now go to para number 2. Auditor's report to contain matters specified in para 3 and 4 of the CARO 2020. Now, where does CARO get its authorization from? It gets it from section 143 of the Companies Act, where the auditor of a company, on the accounts of every company audited by him to which this order applies, for the financial years commencing on or after April 1, 2019, shall contain the matters which are specified in paras 3 and 4. The previous CARO was applicable from 2015, so they'd given it about 4 years' time, 15, 16, 16, 17, 17, 18, 18, 19. And the new CARO is now ready to strike. So the operative part here is it applies for financial years commencing on or after the 1st April 2019. A very interesting change here. Previously, it just said, provided the order shall not apply to auditor's report on consolidated financial statements. But now it says, provided this order shall not apply to the auditor's report on consolidated financial statements, except clause 21 of paragraph 3, which we'll come to later, demands certain additional reports by an auditor on the other companies which form part of the CFS. Let's go to para number 3. Which is, we'll go through as much as we can in this video and then we'll stop at some time and move on to the next video. So what are the matters to be included in the auditor's report? The auditor's report on the accounts of a company to which this order applies shall include a statement on the following matters, namely, A. The first clause was always fixed assets. Now, in terms of the number of clauses on fixed assets, it was previously 1, 2, 3, that's it. Today we have 5, A, B, C, D, E. Para 3, 1, A, B, C, D, E. There's a change. Para 1A, there's an additional para which is getting included, a separate paragraph for intangible assets. They had earlier used the term fixed assets. They now call it property, plant and equipment. Whether the company is maintaining proper records showing full particulars including quantitative details and situation of PPE. The second clause, whether these fixed assets have been physically verified by the management at reasonable intervals, ditto. Whether any material discrepancies were noticed on such verification, ditto. And if so, whether these have been properly dealt with in the books of accounts, ditto. The only change is PPE, fixed assets. Here there's a bit of a change. The next clause, which spoke of title deeds of immovable properties held in the name of the company. They've done an exclusion here. You don't need to report on properties where the company is the lessee and the lease agreements are duly executed in favor of the company. All other immovable properties disclosed in the financial statements, though they have already also included that. They've said disclosed in the financial statements, which is sort of a benefit to the auditor. Because how does an auditor find out if some immovable property is not at all disclosed? Are held in the name of the company, if not, provide the details in the following format. The format is fairly simple. And it also says if there's a dispute, you must also indicate whether there is a dispute. Now the fourth clause, which is a new clause, is on revaluation. Whether the company has revalued its PPE or intangible assets or both during the year, and if so, whether the revaluation is based on the valuation by a registered valuer. So please remember, these are valuers who are supposed to be registered with IBBI. Specify the amount of change, or the registered valuers organizations, the RVOs, the whole framework will apply. Specify the amount of change. If change is more than 10% or more in the aggregate of the net carrying value of the class of PPE. So revaluation reserves, when they're getting created and it's more than 10% of the net carrying value, then you will have to do an additional disclosure. This is basically a disclosure. Now, the Companies Act also provides that all valuation has to be done by a registered valuer. So if this clause is in the negative, then you also know that there is an adverse finding there. This is an interesting inclusion where any proceedings have been initiated or pending against the company for holding any Benami property under the Benami Transactions Prohibition Act and rules made thereunder. And if so, whether the company has appropriately disclosed the details in the financial statements. So these are the new clauses on PPE and very minor modifications to the existing clauses. Then we come to clause number 2 and we'll stop this video with inventory. Now, inventory is very interesting. There are some major changes in the way we handle inventory, although a bulk of the procedures that we would have performed have been there. we're now specifically required to transparently disclose. So what are the points to note here? Whether physical verification has been conducted at reasonable intervals by the management. That's important. Whether in the opinion of the auditor, that was not there earlier, the coverage and procedure for such verification is appropriate. That's very, very relevant. Maybe I'll come out with something else on this. The entire task of physical verification needs to be handled very carefully because it's that value that comes outside and then gets again into your accounts. Whether any discrepancies of 10% or more in the aggregate for each class. So if you have stores and spares as a class and then you have an issue there, you might have to report. And if so, whether they have been properly dealt with in the books of accounts. So you must look forward to more guidance on this. And I think what's very relevant here is that each word here has a meaning. Each phrase here has a meaning. So they're talking about A, verification at reasonable intervals. 2, they're talking about procedures followed by the management, which means managements today perforce have to issue stock verification instructions. You need to have a strategy for stock verification, and those need to be reviewed by the auditor. Not that we wouldn't have done this otherwise, but today, given the thresholds that it applies to, even small companies will have to start doing this. The second is a very interesting inclusion. Again, it says, talking about working capital limits in excess of 5 crores. Whether during any point of time during the year, the company has been sanctioned working capital limits in excess of 5 crores in aggregate from banks or financial institutions on the basis of security of current assets. So this is your CCOD, which is largely covered by your stocks, book debts, etc. Whether the quarterly returns or statements filed by the company with such banks and financial institutions are in agreement with the books of accounts. It's very interesting because your stock and book debt audit could have been done by some other independent chartered accountant and submitted to the bank, not being the statutory auditor. It could have been done by the bank appointed stock auditor. But today, and it's pretty much possible, that the system might have got gamed. Somebody might have shown the visiting auditor one particular reconciliation and said it's matching to my books, and then later on the books get altered by reversible journal entries where the stock entries have got reversed. So today, as a statutory auditor, every such stock and book debt statement, whether it's quarterly or whatever, which has been furnished to the bank, you need to go back and ensure that it is reconciled to the financial statements as at the particular date of submission. Consequent to which you will also end up reviewing large entries before and after to make sure that these numbers were not window dressed. So I think it's a fairly important point here. With this, let's stop this particular video. I've covered 2 clauses in para 3, which basically deal with property, plant and equipment, and inventories and working capital. Stay tuned for more, and see you in the next video.